Investing £200,000 into property can be life-changing due to one thing in particular. Let's compare it like for like with an investment in the stock market. And imagine that you invest this much and both of those assets increased by 5% in 1 year. You might assume that you make the same amount of money on that growth, that is £10,000, and then you've got rental income on one side and dividends on the other. But the beauty of property is that with £200,000, you can use a mortgage as leverage to buy, let's say, £600,000 of property. So if the market does grow by 5% in a year, your wealth grows by £30,000. That's 3 times more. With the same investment, you get way more buying power and way more potential upside. So what steps do you need to take into consideration? Well, before you spend anything, there are a few basic things that you need to get clear on. We've covered all of these topics in detail in our other videos, which I'll link to below, so I won't go into them in detail now. But as a quickfire summary, figure out if you're buying in your own name or through a limited company, because this makes a huge difference to your tax. Understand the fundamentals of the property market and the basics when it comes to laws and regulations. Get your head around mortgages, the rates, the process, what lenders look for, and how to get comfortable with and control for the risks. And you need to set clear goals about what you want to achieve, whether that's monthly income or long-term growth. Now, the 4-step strategy that I'm going to show you isn't for short-term gains. So if you're expecting to take your 200,000 and turn it into $1 million in 6 months, you can stop watching here. But if you're focused on building long-term wealth over the next 10 to 20 years, then this is exactly how I would invest £200,000 into property right now. I can't tell you how often I've seen people fall at this first hurdle. We once had a client who'd already invested £200,000 before he came to us and told us that he'd bought 10 properties with it. And on paper, it looked impressive. He could tell his friends that he was a double-digit property investor. But when we dug a bit deeper, we discovered a painful truth. Years after investing that money, those properties had seen almost no capital growth. And what's worse is that he was dealing with endless maintenance issues, troublesome tenants, and constant headaches. So even after dealing with all that, he wasn't even making much money. He'd fallen into a classic trap, focusing on the number of properties rather than the quality of his investment. You see, when you've got £200,000 to invest, it's tempting to go to one of two extremes, either trying to buy as many properties as possible to maximize your portfolio, or going the opposite route and putting all of your money into a single premium property. But both of those approaches can seriously limit your potential, because the true value of your portfolio isn't about how many properties you own. It's about finding that sweet spot where you have enough properties for diversification, but not so many that they become unmanageable. And after years of doing this, we found that there's a balance that tends to work well.